I'm sure that they have some hedging strategies somewhere, and this can cause, depending on where people have their manufacturing production, it can cause headwinds. But what companies will typically do is they will report organic growth, which excludes the impacts of FX. So analysts have that great ability to look through any kind of FX headwinds.
That move we saw into non-U.S. equities earlier this year, principally into European equities. You have European indexes outperforming U.S. S&P 500. Is that a short-term trade, or is that something longer, do you think?
Well, the beginning of that trade was mostly a re-rating, meaning that you were trading at such a huge discount to the U.S. You were going into the year, U.S. trading at 22 times, Europe trading closer to 12 times. So some of the easy part of that move is over. But what's been really interesting is that we've actually been seeing more earnings revisions higher for European companies, which suggests that maybe there's a little bit of life there.
It's Paul's turn to ask a question. I'm going to be rude and butt in. Is the bottom line the market going up because everybody's reframing earnings higher? Is that really what's going on, Kim?
100% yes. Markets do not like when you are cutting GDP and earnings estimates. So if we think about how markets have been sideways and choppy for really the last 9 months or so, that has been concomitant with this decline in GDP and EPS. But both of those have started to stabilize. The question is, do they go up much from here? And I'm not quite sure about that.
I'm just looking at a note from Torsten Stock from Apollo. The lower dollar, Tom, more international travelers coming in to the U.S. airports.
Oh, yeah. Well, please, let's stop the show for a moment.
Exactly.
118 euro. How does that trip to Rome look?
Okay, I booked my Italian trip maybe 6 months ago with a much stronger dollar. So maybe I'm getting a little bit of an arbitrage.
You're going to top tick the Bulgarian martini at 42 bucks.
I know, exactly right. So, Cam, what do we do here with earnings coming up? We're going to have earnings starting in a couple of weeks. We just flipped the calendar to July, which makes you think about earnings. What do you think we're going to see in this earnings cycle?
I think that investors are conditioned to expect beats and optimism because we went into the first quarter expecting 7% growth and we got 12. This quarter, the Street is expecting 4% growth. So there's an expectation.
Really? The numbers are 4%? I didn't know that.
The number's 4%. Now, there is a tougher comp, which just means that the second quarter growth from 2024 was higher than what we had in the first quarter.
Here, Brent Schuette's coming on, Barry Reynolds coming on. Is it a melt-up? Is that what we're in, even if it's a grind higher a little bit every day?
It's hard to frame a upward move in the market as a risk, but we would typically say a melt up is a risk because typically what comes after melt ups is melt downs. But we would know that you still have positioning that is underweight or light this market, which suggests that people still have to chase in. So if you have beats in the earnings season in the second quarter, we think that suggests that we pressed continued highs.
Retail's all in. What are institutions doing? Are they playing catch up with retail? Wait, did they window dress yesterday?
Yeah.
Talk about a phrase.
Yeah,
so
exactly.
You're too young, can't even remember window dressing. But did they window dress yesterday?
I'd like to window dress on Fifth Avenue. But yes, I've
seen you outside Prada.
I do think that is one of the dynamics that is happening is that institutions have largely sat on the sidelines of this rally. And so they're having to chase markets in order to get fully invested. Retail, very different. They are all back in. If you look at something like the FINRA margin loan balances.
FINRA margin loan balances.
A really great way to capture how much leverage.
I know.
Thank you. If you couldn't hear him, he'd call me a nerd. That it's a great way to capture how optimistic individual investors are.
One more.